Hi, everyone. This is Matt Williams from JTM Williams Capital Management. This is your review for the month ending March 26, and it was indeed a month. As a reminder, the ETFs, indexes, and securities mentioned in this video for illustrative purposes only and do not constitute a recommendation to buy or sell. Please refer to the disclosures at the beginning and ending of this video. I'd like to start off by wishing everyone a very happy Passover, Good Friday, and Easter. I'm recording this on Good Friday, April 3rd, 2026. Let's get started. So I'd like to share my screen. Let me start off by just review what was the big news here this month. It was obviously, last time we spoke, I was recording right after the U.S. Had military strikes against Iran, and obviously that evening we were waiting to see what oil was going to do. Well, obviously, it spiked up quite substantially. It started off, I think, when I recorded the video, WTI was just below $67 or $68 a barrel. And as of the close yesterday, we're hovering a little over 110. That's been the big story. This month, it's been a binary trading environment where you've either been long the war or you've been short the war, really here up until a few days ago, where you've either been long the S&P, long gold, long bonds, short oil. The exact opposite of that, if you're long the war, it's long oil, short stocks, short bonds, long the dollar, long volatility. And it's really been binary again, as I said, up to a few days ago when yields started falling. Let's review just the chart of the S&P. As we can see here, we had about a almost to the penny at a 10%, close to a 10% correction here before the bounce the last few days. At least the way I look at things as far as, what to do here moving forward is we've had the initial down move, and I would say there's most likely probably one of two scenarios, that I would look at. Either, this right here was a failed breakdown. I preferably would have liked to have seen us go down and retest the high from the previous breakout from February of last year before the tariff tantrum. If you go back and look at the S&P here, really the last 5 to 10 years, what we've been doing is most breakouts have been going back and retesting the previous cycle high. So from the COVID low, we effectively retested the breakout or the previous high from October of 2018. The low in the bear market of 2022 bottomed almost exactly to the high from COVID. The bear market here that we saw where we bottomed here around 48.35 last year from the tariff tantrum, we went back and retested the high of around 48.35 from January of 2022, so on and so forth. So as I mentioned, as far as it being a little cleaner of a retest, would have liked to have seen us maybe get down here, be a little more convinced that was a durable bottom, but we'll see. Again, what I would look at is I think there's two probabilities. Either this was a rounding top that had just had a failed breakdown and we rip higher as CTAs and a lot of managed money got extraordinarily bearish here in the last week or so and got positioned net short. And right now, obviously, if, any less bad news or good news that could precipitate a fairly large short covering rally, and we'll just have to see where that takes us. Other possibilities, this ends up looking somewhat like last year, where, we had the initial down move from, February 18th down to about March 13th. We had a bounce that failed at previous support and this downtrending moving average. And also, I don't have it on here, but the anchored volume weighted average price from the previous all-time high was around here during that down move, and obviously we failed and had a lower low. The anchor weighted volume average price from this all-time high from January 28th is fairly close to this downtrending moving average. So again, what we'll see is potentially either, again, this is a failed rounding top, that this right here was a failed breakdown, and we end up rallying substantially off of here as a result of short covering and positioning being too bearish by managed money. Or, we'll hopefully potentially rally a little bit more here up to this downtrending moving average, and we could end up making a lower low to get down to this, somewhere between 6,100, 6,150 level. Chop sideways again. This is a midterm year. Most midterm years, if you look at the seasonality, the middle of the year typically is challenging. So it would not surprise me again, if we just have some sideways movement, chop here throughout the spring and summer. Normally, if you look at the seasonal patterns, we end up bottoming sometime around the midterms, and then after that, you end up getting a fairly substantial rally. Now, again, I'm not dogmatic about things. I think that's more just you have to be aware of those seasonals. Don't get married to them, and obviously, you just trade price and keep an open mind and take things day to day and week to week. Now, moving on, what I'll say is we'll go look at crude oil again. This has been the big news. As I mentioned in the previous video, we had we were positioned and bought a very energy crude oil heavy commodity ETF in the middle of February. I like the chart. And obviously we've held on to that here so far for a pretty decent gain. We'll just have to look and see, how much longer this lasts. As far, as I look at it, crude has effectively been trading, almost as a inverse to the S&P or a fear hedge with what's been going on in the Middle East. What I would say is I'm going to show just a longer term chart of what typically happens with these oil spikes. Now, this is a monthly chart going back 20 years, and you can see the peaks, the peaks that have occurred. Normally, energy likes topping out sometime around the middle of summer. So if you look before the financial crisis, WTI topped out right at the beginning of July of 2008. Most years when you see we've gotten oversold, it's been sometime either in the spring or middle of the year. Even here, let's say like the last time we had one of these pretty major run-ups in 2022 after Russia invaded Ukraine, same thing. We ended up topping out, there in June. I believe it was like middle, late June. So it was very similar to the action you had in 2008. Again, not making a prediction. We'll see, how much longer this lasts. Obviously, if there is some, ceasefire, if the Strait of Hormuz gets opened back up, I imagine crude oil is going to have quite a tumble. But again, we'll just have to see to take things day by day. Other interesting things I say I'd be looking at here right now. We had a pretty decent breadth thrust here in the last couple of days. So again, I think as always, like there's some things I'm looking at that are a little bit on the worrisome side. There are some things here in the last couple of days I think, are pretty constructive. Again, right there, we've had a pretty decent breadth thrust if you go by the percent of stocks above their 20-day moving average. A good place to potentially, maybe show this as if we looked at the McClellan oscillator. What this is it's basically a momentum indicator for the advanced decline line, and you've gone one as we were making lower lows in the S&P. This was not making lower lows, so you had a bullish divergence, and we've gone from negative 87 up to almost 20. That's effectively classified as a short-term breadth thrust. Again, price is the only thing that pays, but again, this is something I'd say would probably put in the checkbox of being constructive. So, moving on. Other big issues we've seen here this month have really been in the bond market. So, if you look here, when this started, the 10-year yield was at a little under 3.9, excuse me, a little under 4%, and it was rallied all the way up to almost 4.5. That's mostly because as oil has increased, everyone's looking at inflation expectations going up. Here's what I'd say as far as where the Fed's going, and I think this might be an interesting chart to, share with everyone. Let me go back and let me show this. Give me just one moment. Here's a chart of 2-year yields. I'm going to show a weekly chart of the last 10 years. So where I am a little concerned here is that, as you see, is the 2-year yield came up, and it looked like we wanted to get below 3.5. And the way I would look at things, if we got below 3.5 and again started falling, we got more expectations for Fed rate cuts. This would at least put it to where we could go down to 3%, 2.5%. What I'm worried about here is that this very long consolidation looks like, again, a potential failed breakdown. And when I see this downtrend line, there is the potential that, again, just by looking at the charts, we could rally up to 5.25, 5.5, perhaps even 6%. not a prediction, just but when I look at the chart, that is a concern from that failed breakdown, and now looking like this may just be a major like falling wedge that looks to potentially resolve to the upside. Again, not a prediction, but just something to keep in mind as far as your fixed income exposure. Now, I'll say again, be very mindful of that, because obviously, the last time we had a substantial move up in rates there in 22 and 23, until we started stabilizing, the stock market did have some problems adjusting to it. So obviously moving forward, we'll just have to, again, see here, going back to the S&P, again, the two scenarios I think are the most likely are either one, this was a failed breakdown, we have a breadth thrust, and we, caught a lot of people that got very, very bearish too late in the down move, and we end up, you know, rallying from here as there's systemic short covering, by, uh, you know, quantitative fund managers and CTAs, or again, the other possibility where I think that, we have something that looks maybe not as bad as what happened here last year, but we, have this bounce, try to get back up here, we have resistance that was broken support, come back up to these moving averages and end up ultimately making a lower low that bottoms hopefully somewhere around the previous cycle high before the tariff tantrum, consolidate a little bit, and we have a, pretty good rally to end the year. Like I said, not a prediction, just, looking at, where I see some probabilities, but obviously we'll take it from there. So obviously this is going to be a shorter video. I am also, like I'm assuming most of you, going to be traveling to go see some family here today. So again, I hope everyone has a great Easter weekend, a great Passover. If anybody needs to reach me, I can be reached at matt@jtmwilliams.com. Please go to the website. If you need help or want to discuss any of this, please feel free to reach out for a complimentary consultation. Look forward to hearing from you. Hope everyone has a great weekend, a great month of April.